Good morning. It is a very nice morning as we open up Wednesday's live stream. It is April 23rd, and it's before the market's opened. The market's going to open up much higher. The futures are up 3% on the NASDAQ. The S&P is going to open up 2.5%. The Dow is going to open up 2%. Oil is coming down in price. I was just looking at long-term rates. They are coming down, and that is a good signal that the global market for bonds is thinking things are getting better. And the tariff talks and the tariff news has really caused the market to sell off substantially, right? Over the last 2 months, call it. It's just been a really tough stock market, with stocks on the NASDAQ year to date, they're down 15.59. And from the high to the low, they're down 23.87. And I think a good part of it was that not knowing what tariffs were going to be in place and how hard they were going to hit the economy. And now it seems that that's beginning to soften up a bit. And if tariffs were completely off the news stream, I think the market's going to now just focused on earnings, the economy, stuff like that. Get re-excited about certain trends in the markets and so forth. But we're at the beginning of that news cycle. So let's keep our fingers crossed that the story around tariffs is going to hold, which is, hey, China and the U.S. are probably going to figure things out, get that kind of settled. We can go back to just, focusing on letting these businesses operate, provide the products and services that they provide to their customers, and operate effectively. Then we can invest in companies based on their intrinsic value, based on their ability to really outperform the competition, operate well, profitably, generate free cash flows, that good stuff. Principally, that's the investor I am. I have to look at, the economy and look at what's going on, obviously, because it provides, opportunities, and it certainly provides a threat to yields and appreciation as well, which has been the case here in 2025. We've had a solid correction, and I think we were due for that correction, as I've mentioned before. So it's not all bad if we have better valuations. There's more companies that I could buy that are priced well. And priced well means intrinsic value. The way that I invest, I'm a long-term investor. I want to look at a business true intrinsic value, which is principally its ability to be profitable, its ability to generate free cash flows. And then I take a net present value of those free cash flows and determine what I think the intrinsic value is of that business, and then compare that to its current stock price. And before we had this correction, it was hard to find companies that fit that criteria. So my complaint 4 months ago is, boy, stock prices are expensive. Now I'm not complaining that stock prices are expensive. I'm more complaining on, wow, these tariffs are really hurting stock prices. And it'd be nice to get that off the table so we can go back to just letting these companies operate, and, based on their performance, certain stocks will go up, certain stocks will go down. And we're in earnings season. So we're right in the heart of that type of, I think, thought process, is looking at earnings and seeing if these businesses did operate well. Are they growing their top line revenue? Are they outperforming their competition, providing products and services that are so desirable that they get more customers, their existing customers are buying more product. Those are the natural, I think, attributes that I like to look at in a stock and invest in companies that are just really good businesses to invest in and hold for a long time. So thanks so much for joining. We've got a lot of people on the stream. I appreciate Shadow Guy being on, and with some good questions. I'll get back to the chat in a little bit after I open up with a few comments and kind of review the markets. We are going to open up higher, and it's a second consecutive day where the market's really going to go up. Now, the volatility is extreme, right? We're going from just really bad days to really good days. It's not anybody who says stock investing is boring, maybe hasn't been investing in 2025, because it's been everything but boring. It's been a little too exciting at times on the downside. So the NASDAQ's going to open up in the positive. Crypto has been really showing up, and crypto kind of untethered itself to the stock market. Many times, Bitcoin was trading like a high-tech stock. If growth stocks were flourishing, Bitcoin was flourishing. And they were kind of trading together inconsistently, but Bitcoin started to trade away from the stock market and more like gold. And that really excited investors. And the stocks really, or excuse me, the Bitcoin really flourished over the last, over the last 5 days. It's up 11%. Over the last month, it's up 11%. That's really good, because if we compare that to the NASDAQ over the last month is down 10%. The Bitcoin is up 11%. That's a 21% differential. That's making Bitcoin more desirable because more investors are seeing it as a hedge on the stock market. And it's a hedge on a lot of things. It's a hedge on inflation. It's a hedge on currency. It's a hedge on many different things. So that promise of Bitcoin is beginning to become a reality, that, hey, Bitcoin is a hedge. Now, I personally invest a small portion of my portfolio. I'm not a pure play Bitcoin investor, crypto investor, where, hey, I put all my, net worth in Bitcoin. No. To me, it makes sense to have Bitcoin. It makes sense to have a little bit of it in my portfolio, but my net worth is tied. My biggest portion is in real estate, then stocks, then bonds, then Bitcoin. So Bitcoin is still a small portion of my portfolio, but it's been a high performing asset for my overall, net worth. I started buying Bitcoin in 2018, and the only mistake that I made was I didn't buy enough. Because if we look at where Bitcoin was, and I can't even go back that far, but maybe if I hit the max, I will. Yeah, here we go. So I started buying actually before this run up, and I mean, I remember 1800 being when I started to buy. So I started buying around 1800, and I remember that number. And now the Bitcoin's at 93,000. So it's been a wild success. It's been a little bit it's such a new market that I played it safe and don't invest in something you don't understand. That's one of the things. I studied it and got into it with amounts that I felt was okay to invest. And then over time, it became more comfortable. I invested big here and have been buying on occasion around here, but this is where I put a good allocation of capital, and a very small allocation of capital, and it's worked out. So Bitcoin's really looked great over the last month. Currencies. So I know that this is a stock investing live stream, so I'm going to touch this and then move on. I usually don't look at currencies. It's kind of not, in most cases, not that important to me. But now it's really showing up because the euro, as an example, is gaining a lot of strength against the dollar. It's really gained a lot of strength as we have all this tariff war stuff going on, and we see that, hey, Maybe there's a loss of confidence in the US dollar, the loss in confidence in US debt, treasuries, and that that the currency change could cause inflation. If you think about products that we're getting from other countries or materials, they could become more expensive. And the other thing about this is it may change like earnings reports. It may help some businesses that are doing more business internationally because they're receiving currencies or the currency translation is going to be favorable to them, or the opposite, which is if you're trying to sell something made in the US, um, you're going to have I think that's you're going to have an easier time selling it abroad. But when you're importing products, you're going to pay more. So it's just one thing that usually I don't even look at, but it's moves so fast that it's like, okay, I've got to look at it. Um, I took a vacation to Europe. Geez, it was 15 years ago, approximately. And the euro was trading at a dollar 35 ish, to the US dollar. So I took the vacation and I have two sons and my wife, and we had a great time. And I spent a lot of money, and it was the currency exchange was pretty high. I went to Europe here in 2023. I've been to Europe 4 or 5 times, and but just to compare 15 years ago versus 2 years ago, and in that year, the euro to the dollar was about 1 to 1. Actually, it was like a euro was less than a dollar to one, less than less than one US dollar. And that vacation was less expensive over that 15-year run. So it goes to show that if we start losing value against other currencies of the world, their products or services or vacations are going to get more expensive. And that's my point there. So, all right. So that is where currencies are at. What's going on over in Asia? Looks like the Shanghai is down a little bit. That's a little bit of a surprise. Then Japan, the Nikkei is up. That's right in line with what I expected. And then in Europe, they should be up. They should be going up on the positive news, but maybe this thing will reset. There we go. So it looks like Germany up 2.48, UK up 1%, and then in France up 2%. So looks good. Looks like we're going to open up in the positive in about 16 minutes. And this is kind of a unusual day, right? Because we have a lot of earnings that I'm going to cover. And I've got a couple stocks that a member wanted me to take a look at, which I'm going to do. And we're probably going to see a lot of green. And the reason I say it's a little difficult to ascertain, like, is this business were the earnings good or are they bad? How are they being processed? Because there's just a little bit of euphoria right now that everything's going up. But we'll look at the fundamentals. We'll look at truly, did they grow their businesses? How is their cash flow? How's their profitability? And we'll go through it and make sure that we arrive at an intrinsic value versus just kind of getting on the hype train. And speaking of hype, I'm going to be sure to talk about Tesla, that's not a hype train. That's like that's a hype movement, in my opinion. Hopefully nobody's angered by that comment. All right. So we covered crypto, covered the markets. This fear gauge, I'm not one to really like look at oversimplified measures, but this one's pretty good. And it's really moved, I think, in the right directions as I've seen like the stock market and the news flow change. And not too long ago, we were like down to 7. Now we're up to 25. So we're moving in the right direction. Moving in the right direction. Let's hope that everybody sees that, hey, when we stop talking about firing the Federal Reserve chairman, stock market goes up. And we start socializing that, hey, these tariffs are probably going to go away soon. Stock market goes up. Things begin to kind of fall into place that I think in the US, the leadership wants the US to have a good economy, people to have jobs, people to flourish. And so hopefully that's basically the path we're on. And we've had a solid correction. So stock prices are lower. In some cases, they just get lowered at a higher rate. The stock market is not efficient at all times. Some stocks are, but most stocks are not. And the goal is to find stocks that are basically below intrinsic value. Like this example here, this slide, stocks will trade at a certain stock price, and that's what the market's willing to pay. But if we measure a stock's free cash flow value, earnings per share value, we could say, no, that stock's actually worth more, because if you remove the name of the company and you remove kind of like the identity, but you look at that cash, what would that cash be worth if they delivered it to stockholders over time? Well, we can make that measure, that calculation, and then see, hey, this stock is worth considering to buy because it's actually worth more. Its cash flows are higher, as opposed to a stock like this, where, hey, this stock's really popular. I'll give it that. But it's true, if you remove the stock ticker, its identity, and you just look at the cash flows and it looked like this, I wouldn't want to buy that stock. I don't care if it's popular. I don't care if it's cool. Money's cool. So that's what I'm trying to do with my investing. And that's what I cover in this channel. So, the market's super green. It was super green yesterday. It looks like it's going to be super green today. But I thought what would be interesting is let's go back. Let's go in the time machine. Go back a month. And over the course of a month, this is the heat map for the month. And it looks like Meta's just gotten, hit pretty hard. It's I think the talk about breaking up Meta and how the FTC is going to probably do something. They're probably going to hit them with fines and limit how they can operate and so forth. But it's really hit the price of the stock. So that's been down. But things like Netflix, man, look at Netflix, flourishing, Costco. Now, consumer staples totally get this because we've been kind of in a spooky period. So not a bad idea to be in staples like Walmart, Costco, Coca-Cola. I think this is Marlboro, and this cigarette company, and others within staples. A couple other spots: Palantir's buck the trend, Abbott, Cigna, Merck, McDonald's. Of course, McDonald's. You can go there. Say what you will about McDonald's, man. You can get a decent meal for a decent price. So that's why investors think, hey, that's going to be a good one for a recession. TJ Maxx, discount retailer, utilities did well. And let's go for the year-to-date heat map. Who's holding up? Well, there's a little more green because we've got a little more of a time period. And healthcare is doing okay. Some are doing better than others. Looks like Lilly's doing well. Elevance, J&J, Amgen, Cigna, CVS. CVS is up nicely. It's 45%. Vertex Pharma up 21%. So that looks good. Consumer staples. Now, what's interesting is consumer staples there's no other than this tobacco company, this is the home run within the space right there. Netflix is looking great. T-Mobile's looking good. AT&T is looking great. Berkshire, look at that. Of the big valuable stocks, Berkshire's won the prize for the year for sure. Insurance looks like Progressive is doing great. Aerospace, a lot of stories around, oh, well, now that, we're going to have, we're, we're, we're going to shy away. The US is going to shy away from being a member of NATO and defending all these countries and so forth, and asking them to kind of defend themselves a little more in the future. That created a big aerospace and defense rally. So we'll see how the market opens up in about 10 minutes there. The sectors, this moves very slowly, but I like to look at it. It just reminds me of which sector is doing well. Materials. And I started investing in materials companies. So far, so good. I'm glad I started to do that. Staples, I'm not a big fan. I own one staple stock because these, as soon as the market gets back on a growth kind of sentiment, Staples will not do well. And I don't like having my capital tied up in Staples. And utilities, I really like where materials are at, because if we do get rid of tariffs and we do start kind of getting back to normal, I think material stocks are going to continue to fly up. We'll see. Financials, utilities, healthcare, and then technology is still lagging because it's lost so much, but it's had a couple good days. So we'll see where it goes. All right. So that's that. All right. So we have a lot of earnings. So Philip Morris is a big name that announced this morning. So I'm going to cover that. I'm going to cover AT&T, Thermo Fisher. I'm going to cover a lot of stocks. But let me read the comments, and then I'm going to actually get started with a member request, 2 symbols. So let me go through the comments here. Android PC, good morning. Hope you're doing well. Shadow Guy, what's up, Shadow Guy? Zubio. And Mike, good to see you. Nothing wrong with taking profits. Yeah, you're right. And I've been, I put in 1 sell order, and I've been kind of lightening up my Airbnb position, because I think travel is going to really really be hurting for the remainder of 2023, 25, and then 2026. So I put 1 sell order on that. And we'll see, because I want to have some cash around this year. I'm glad that I had cash to buy into some stocks that I really liked, rotate into materials as an example. And it's a time when, I think a lot of investors freeze because, it's pretty hard to look at your portfolio and you're down a lot, where I don't want to do that. I want to actually act and, hey, let's go invest in the right stocks. Let's make some moves that are going to pay off over time. That's what I'm trying to do. I need the cash to do that. Cash is oxygen to an investor. It's the grease that helps us make the investments to pay off, that will pay off over time. So nothing wrong with taking profits. All right, so let's get started. It's going to be, we'll get started with a member request. And it's the first symbol is NBIS. Okay. It's funny is I was in San Francisco yesterday, and I was going to some meetings, and I was on the 101, and I saw one of their billboards. So I was like, hey, yeah, I recognize that company. And so they do full stack infrastructure for the AI industry. So they do high performance computing. So the companies that are trying to create AI businesses and create these large language models and so forth, they need really high performance data centers. And it looks like these guys are trying to provide that for the industry. We've looked at this company before, and let's take a look at it again. This is a $5 billion market cap company over the past year. Wow, look at this. It went way up. It was up to $48 a share. Now it's down to $21.86. So for the 1 year, it's up 15%. Did they IPO? roughly a year ago. Yeah, it looks like the IPO. No, they've been around for a while. Okay, so what's with this flat line here? Huh. Okay, so for the 1 year, they're up 15%. Revenue is 117 million. So you're paying as an investor, you're looking to pay about 40 times sales. It's very expensive. Okay. So paying a pretty big price for a stock. They're not making money. They're a younger business. Analysts are a strong buy with the price target being much higher. Growth has been good, but what's going on here? That's kind of unusual. So I'm not, are they changing business models? Okay, I'm gonna have to go to their actual website and look at their financials because that does not look doesn't look rational. The numbers don't line up. Okay, so okay, I'm gonna look at their earnings release and then I want to get to their 10K. So these guys are in Amsterdam. Okay. So in Q4, the group's revenue, 37 million, increased 466%. So they're saying that they actually grew substantially. They raised capital. They raised 700 million in a funding round. Now, one thing that happened recently, another company that is in this space IPO'd, and the IPO, the initial couple of days, it didn't do very well, and then it kind of rallied. So, be interesting to take a look at that one. And what was that name? What was the name of that? Forgot that particular company. Hopefully, it'll come to me. So CapEx, huge CapEx spend. These guys are spending a lot of money on technology that goes into that data center. And then they're basically renting out like compute, high performance compute, GPUs from NVIDIA. Companies come in, say, hey, I want to build a large language model. Maybe Disney's sitting there going, hey, we got to build AI because we don't want to be left behind. We want to basically reserve that capacity and contract it. These guys say, you got it. And they sell them a contract. All right. So here is a good compare revenues. So based on their revenue amount, they grew 462%. Now that is impressive. Now, one thing that I would be cautious about, right, is it's one thing to sell a lot of, in this case here, this is a service. This is a data center service. But how profitable is it? How profitable will it be in the future? Because the value of business for me is it'd be great if these guys are like Meta, where Meta doesn't do a whole lot when it sells its advertising to other businesses. The other businesses buy advertising, and Meta's literally making close to 90% margins on that sale because they operate computers, people use those computers, and then the advertising is super profitable. So let's take a look at their financials. The balance sheet I'm expecting, they got cash. So cash went down quite a bit. See, it went up quite a bit because they did a funding round. I'm reading it backwards, so sorry about that. And so they have the good cash pile there. They could operate for a while. Now I want to look at profitability, right? I want to see, is this business eventually going to be really desirable? And There's a couple of things that I need to keep an eye on. First is scale. They're young, they're small, so I have to kind of imagine a future where they once they get up to scale, will they be more profitable? So let's take a peek. So cost of revenues. Now I'm going to start talking a little accounting with you guys, but it's important. So revenue, I think, is easy to understand, right? They sold these data center services to a client, a company. And once they render those services, they earned the revenue. Okay. So that's earned revenues. Perfect. Now, this line's really important to me, cost of revenues. How much did it cost for us to provide that service? So in this case here, it was $73 million. And this is for the full year. And this is dollars. Yeah. I was double checking to see if it was euros. So looking at 117, so it'd be 73.4 divided by 117.5, right? So just to do a quick calculation there. And I'm going to put this guy next to NVIDIA. We'll do a full, well, I don't know that I can do a full valuation, so I better pump the brakes on that idea. For now, let me just look at a couple calculations and see if I can arrive at some conclusion. So it's actually so it'd be 37% margins, gross margins. And so this is 37% gross margins. That's not very high. Now, it's not like super low, but it's not very high. It's not super exciting like, hey, you're a software company, your gross margin is 80%, 90%. So then I could imagine very quickly, once you get to a certain scale, you're going to be really profitable and you're going to make lots of cash. Instead, it's like, whoa, okay, that's not a lot to work with. Because after that, you have to pay for product development. And for them, product development is, that their customers are trying to do certain things with high performance computing. Hey, I want to build an AI model that looks like this, or I want to do that. And they have to have engineers and so forth figure out, okay, what product do we have to create and then sell it. They have to have salespeople sell the actual service. And then they're depreciating their gear, but that's not too bad. And this is a non-cash item, so this would go back as cash. But you could see that it's they're losing quite a bit of money. Okay. These with scale, these are not as important. They are important for the short term because if you have too much cost and you run out of cash, then yeah, you can go out of business. But I think over time, these would be things that I would expect are going to go down in proportion to their revenue size. But this number is where it's a little bit concerning. 37% is not great. So it's not making money. It's not creating cash. 37% margins. Okay. All right. So where are these businesses going to go? So on the numbers, right? This is a complete pass for me. It's a sell. It's a, you know what? If this thing works, congratulations. But you're not buying another NVIDIA. NVIDIA is a freaking rock star company. And the reason NVIDIA is so darn valuable, even though their stock's been just getting shellacked, is when we go to their gross profit, 75%. And that's because they design a GPU. And once the design is done, whether you sell one GPU or 5 million GPUs, the design's done. You don't have to kind of buy the design over and over and over again. They have to get it manufactured by TSM. But once they pay for that, that's really only 25% of the product cost. Where our friends at Nebius, if they want to grow, if they get another customer, they have to buy a bunch of gear, put it in the data center, and then provide it to that customer. So NVIDIA becomes really, really valuable, but I don't think Nebius will ever be that. It's not like Nebius actually created the technologies they run. No, they're buying them. And then they're basically providing them as a service in a data center for their customer. They probably don't own the properties. They rent or lease the properties from a data center real estate investment trust. So Nebius will never be an NVIDIA. They should not be confused. They're in the same industry. They're in the same ecosystem, but they're not going to ever be as valuable as NVIDIA. I've used the analogy where you have an American football team, right? And yeah, you have different roles on that team. You have the quarterback, which is probably the most important position on an American football team. And if you have one of the best quarterbacks in the league, maybe that quarterback makes $50 million a year in salary, bonuses, and everything. And on that same team, you have an equipment manager. And this equipment manager is excellent at what he does. He makes sure that all the helmets are there. They have all the right equipment for every game, every practice. And the guy or gal is passionate about their role. And that person makes $80,000 a year. They're part of the same team. They're in the same, they go to the same games. They're showing up and putting a similar number of hours. But if you ask me, you get to choose. You want the position as a equipment manager, or you want to be a quarterback. Based on salary, I'd rather be the quarterback. And that's a decision you make when you buy into a Nebius or an NVIDIA. This is the quarterback. This is the equipment manager. Okay. These guys are not as profitable. So that's one of the reasons that I would totally pass on a Nebius. They're just not a desirable business to me. They're not discounted. I don't see a discount. It's really, investors are buying into it. The AI story is that AI is going to be big, and it likely will be. When will it be big? I don't know. And anybody that says, oh, it's going to be this or that with specifics is making it up. We're not quite sure what it's going to be. We do know that it's going to change the way we use software and technology. I would absolutely agree with that. I think it's going to be ready for prime time in a couple of years. We're going to see some good use cases. I think it's going to be everywhere like in 10 years. But between now and then, it's really hard to be specific about this is what AI is going to deliver. So Nebius is a total pass for me. I'm a long-term investor. I want to get to this decision. I want to know, am I buying at a discount or am I buying at a premium, which I wouldn't be doing? Nebius, I can't even put them on this chart because they don't have any cash flow. It's all a future projection. It's using one's imagination, and it's not a business that I would want to own. If you showed me like a pharmaceutical company or even a technology company where I'm like, the company that I am excited about in the same space and is a company like, because I mean, the NVIDIA stock, right? I've covered that many times on my channel, so you could refer to that. This is the company I'm excited about because I'm excited about this type of growth, 242%. And back to the margins. Look at these margins. That's NVIDIA-like margins. These guys are not going to be as big as NVIDIA because they only do one technology within the data center, but that technology is super important, which is as these corporations start to use bigger workloads across multiple clouds being AWS, and then you have Azure, Google Cloud. You need the networking needs to get far better, faster. You need to move bigger data sets across from one cloud to another. That's what these guys do. And it's like, whoa, these guys are in the right place at the right time with the right technology. They're growing at 242%. Sign me up. Now, are they currently profitable? No, not profitable. Okay. Do they produce free cash flow? I believe they do. This is investable to me. I'm buying into ELAB on pullbacks. And trust me, there's plenty of pullbacks on this stock. you got plenty of pullbacks. And the market, when it pulled back hard, right? Look at this stock. It ran up and it came back down. Well, this is an opportunity for me. It's a beautiful opportunity. Who said stock corrections or stock market corrections are a bad thing? They could be a good thing because it really strips away a lot of the hype and leaves what I consider to be a good company to invest in. So that's my conclusion on Nebius. And hopefully you found that interesting, Mike. Let's move on to the next stock that was requested, which was BMY. Bristol Myers. What? Everything's supposed to go up today. Somebody didn't deliver the memo to Bristol Myers. It's down 13.7% year to date. So that's been a surprise. Bristol Myers, over time, this has been a stock that once you look at fundamentals, you're like, why does this stock not work? But let's take a close look. So it hasn't done anything. Now, I'll make some conclusions later, but this is call it $100 billion market cap company, $48 billion. So you're paying 2 times sales. High dividend of 5%, but I don't think that dividend's worth it. I don't want to give up I don't want my capital to be parked for 5 years and I barely break even. No thanks. That's not good for me. Forward P is 7. Okay. They are growing. That looks good. This looks good. Now, the question is, why are they growing? Do they have a new drug? Do they have something that's new that is creating that growth? That's what I would want to know. And these guys are going to have really good fundamentals. Let's take a look at it. You look at their cash flow. Looks good. They had kind of a cash flow peak in 2021, and then it came down, but it's now beginning to rise. So it looks good. And their gross margins, 75%. Looks good. So this looks really good. If you look at these guys are worth, if their growth is there to stay, if they're going to grow single digit, middle, like 5%, 7%, this thing's worth 150 billion, and they're priced right now at 100 billion. It's to make sure they don't have a bunch of debt, which would change my opinion on them. They do have $40 billion of, net debt. So that would change they're worth 150 billion down to 110 billion. But what I would be curious to know is, why are they growing? Because if they do have to have something new that is exciting, I might be excited. Why? And I don't know that I could do that on the live stream, but I know, Mike, you asked about this, is maybe you already know that. So my question to you, Mike, is, do you know why they're growing? So they have new FDA approval for the most common type of liver cancer. Wow, okay. Maybe that's doing the trick there. Because if they have like a new growth catalyst, like, hey, we are growing because we have this new drug and it's really working. A lot of patients are buying it and doctors are prescribing it. This is going to be a new $30 billion franchise for us. Hey, that's a great reason why I would expect the revenue to continue to grow for the next 5 years. And maybe investors aren't really paying close enough attention to these guys. And that's the question that I would leave with you, because I think if they have a catalyst for growth and they are gonna establish themselves as a decent grower, because this is a big company, $48 billion, this big company, and they're growing at 7, 8, 9, 10%. That's a good revenue growth rate, great profit, great free cash flow. This stock might be worth 200 billion. But we need to get our heads around, the quantitative numbers, right? When we get to a intrinsic value, we can put numbers in here. But to make the decision of what the number ought to be and how we should grow those numbers is a qualitative decision. Qualitative it's a judgment call. And back to Bristol Myers is, we need to understand, like, okay, is the growth a new catalyst, or was it just, some temporary increase in revenue? Hospitals built up their inventory and it's kind of a 1-year thing. Well, I need to be able to decide whether, if it's a catalyst that's going to keep the revenue growing for the next 5 years, or was it a one-time increase in revenue. If it's the case where it's a catalyst, this is a total buy. This is a good opportunity. If it's not, then it's a value play. And this one, you could argue, is a value trap, has been a value trap, where it lured in investors looking at those numbers, looking at the dividend. Oh, that looks really good. This looks really discounted. And then it traps you and it keeps you at a really low appreciation rate. A lot of healthcare companies have done this, which has been one of the big surprises for me in the last 5 years. You see that healthcare companies like this one here had a upward trajectory, and then it came back down and it stayed down, although it had a really nice run. It looks like the market recognized that growth. So Bristol Myers is a good one. But you need to determine, are they going to keep growing? If the answer is yes, it's a buy. If they're not going to grow, be careful, because it could be a trap and you're sitting there 5 years later. It really didn't go anywhere from an appreciation perspective. You did collect the dividend, but I don't invest based on dividends. I invest based on intrinsic value. So that is Bristol Myers. All right. I'm surprised they're down. What's going on? Now I got to look at the market. Is the market selling off healthcare? Yeah, here or there. J&J's down. Abbott's down. Merck's down. Here's Bristol Myers. While we're here, Amazon. Is it Amazon Prime Day? I guess it is. Meta. I guess the FTC is taking the day off, and Meta is flying high. Tesla kind of calmed down a little bit. Wow. Apple's up. Nvidia, Broadcom, they're doing their thing. Consumer staples. Remember that comment I made earlier? When growth stocks and what is typically growth-based stocks start to flourish, consumer staples start to fold. Like, hey, okay, we don't want to park our capital where it's going to go up a little bit at a time. No, We want to move our capital where there's going to be big gains. Salesforce up 5%. Uber is up a little bit, not keeping up with the big boom. ServiceNow, I believe, is going to announce later today. That's going to be interesting to cover. We have a member-only call tonight. It's going to be a big one because we have so many earnings. And we'll probably cover a couple of these, as well as there was an investor that wanted me to cover 3 stocks that I have for that call. And if you want to be on that member call, get signed up. It's easy. Just go to the home page, click join, and you're good to go. All right, so that's what's going on with the stock market at large. Let me check the chat here and see how things are coming along here. Man, you guys have been chatting. Let's see here. So Shadow Guy, you're taking some profits. Good for you. BTC is up. Dollars starting to recover. Good. That is a good sign. And interest rates are dropping on the long term, which is also a good sign overall for confidence in the U.S. Treasury from foreign investment and so forth. So that's good. Brian Silva, thanks for joining. And then Mike, you're in A-Lab as well, up 11%. We'll see where that goes, man. That thing is like, it goes up and down, but I think it's going to do well over time. If they execute on the technology they have and they grow like at 100% at a time, it's unavoidable. The market will start snatching that stock up. James Sketcher. I see a ticker there. You could buy a $5 super chat, or you become a member, and then you can put up a ticker and I'll review it. So please consider either option. And then yeah, so I'm right there with you on Bristol Myers. Is, again, their fundamentals are good, but in healthcare especially, there's just a lot of excitement in, like, Eli Lilly, right, is a perfect example. It's an obvious example. They got the weight loss drug going. They just came out with a pill that people can take and it helps them. That has a huge catalyst, and that stock's just flourished. So I'd rather find a healthcare company that looks like that, as opposed to just kind of an old school, steady Eddie healthcare company, because those are not working from an appreciation perspective. So I think we are on the same page on that one. Zubio, good to see you. Brandon, how are you, sir? Nice. Yeah, it is nice to wake up to green, man. It is really nice to wake up to a green day. The coffee tastes a little better. It's just the birds are tweeting a little more, as opposed to really bad red days like Monday. Ooh, that was a brutal day. And we've had a good number of brutal days, man. All right. So Zubio O'Brien. All right, cool. So thanks, guys, for joining. We're 26 strong on the live stream. I think I can now talk about some of these big earnings. So let's get into it. Let's start with Tesla. So I'm not going to break any news here. The earnings revenue went down big time. Car sales are down 20%. They dropped their margins. Their margins are down to like 3%. It's just a horrible business, the car business. Now, Tesla will sell its vision. That's what they sell to stockholders. And their vision is, we're a technology company. At some point, we're going to have robo-taxis and we're going to have robots and we're going to change the world. And that might be the case, but it may also be the case where Tesla's competing against the world. So if Tesla is going to come out with a robot. They're going to compete against Honda, that's been in robotics for a long time. And they have um, a lot of competition in the different places that they believe they want to get into. Robotaxi, they got Google Alphabet's been there for 15 years. They have Waymo, and there's a Chinese producer that's doing really well. So I'm not an investor in Tesla. I used to be a long time ago, like 15 years ago, 10 years ago, own the stock. And I own the stock because I was a fan. And at that time, I threw a couple bucks at it because I just thought this thing's probably going to work. And at that time, there was probably more doubters than there was believers. And the stock did okay. And then I sold and moved on. But more recently, I mean, this stock is really, really priced at a premium. And my valuation on, let me get rid of this calculation here. So the stock is based on fundamentals, based on intrinsic value, is just priced so much higher. This is the car business. The car business, they don't make a lot of money. They don't, it's just a fact. And it's cool that Tesla figured out how to make an EV and sell a lot of EVs, even though their sales went down. You see that the trailing 12 months went down, but the overall number, their car sales went down 20%, revenue coming down 9%. This is priced as a growth stock, okay? So for them not to grow, it's a big problem. And when you look at their gross margins, 17.66%. Terrible gross margins. Free cash flow is there, but based on their revenue, it's not very high. If you look at this cash flow, and even if I multiplied it times 20, which I wouldn't because they're not growing, I'm getting up to maybe $130 billion of value. And they're way up at 800. It's somebody else's investment, not mine. It's if somebody really believes in Tesla, I think maybe someday, 5 years from now, 10 years from now, the fundamentals will support that stock price. But right now, it's just not in the numbers. The quantitative assessment of Tesla is it's severely priced too high, way too high. And the other fact that is out there is Elon Musk, the AI business they've created, and you could argue that, hey, well, shouldn't that kind of be a part of Tesla? Some people could argue that. But instead, they're going to separate that as a different company. And it's going to be pretty much an IPO that is separate. SpaceX, separate IPO. Well, if they come out with really cool technology and they IPO separately, how do stockholders of Tesla benefit? Are they going to get shares? If they're not going to get shares, well, that sucks. Tesla is kind of like the idea lab for a lot of new ideas, but the stockholders don't get value once those ideas get monetized. Just a food for thought. So I'm not a Tesla believer. I think it's super interesting to see how, and there's a lot of smart investors in Tesla. Let me show you who's in Tesla. I know that, well, not as many as I thought. Wait, wasn't Kathy Wood in it? She's out of it? Man, if Kathy Wood's out of Tesla, who's left? I thought there was more people in Tesla. So Josh, yeah, I don't know. I'm not believing this story because I know that oh, he's not listed on this site. I know Tom Lee is a Tesla stockholder, and I thought Kathy Wood was a stockholder. Some of these websites, sometimes I question their details. I know Tom Lee is in Tesla, and he's losing his shirt. And I thought Kathy Wood was in Tesla. Here it is. So interesting that Super Investor website is not. I got this from Kathy Wood's website, where this is the ARK fund, and I got this data from the ARK fund, and I'm tracking based on year-to-date performance. This is what their holdings are looking like. Her best stock, I think, is Palantir, but Tempest AI is doing really well, 45%. And then Tom Lee, where did I get this? I got this from this is the Granny Shots ETF that he manages. Well, this is, I think, a reflection of what he believes is a good stock to own. And he owns Tesla, which his fund is doing okay now at this run up. The S&P is at 7.37, but keep in mind, you'd have to pay Tom Lee 0.75%. So you really are down 8.16% compared to the S&P. So go Tom Lee. So interesting. Let's look at the rankings real quick. Man, things really changed, huh? Things really changed with the 2 days of positive. Looks like Guy Spears in the positive. David Tepper is in the positive. Let's kind of resort this puppy. See who's on top. I wonder if Mike, the dividend investor guy, is going to be on top. Maybe and Kiter. Whoa, what happened? I don't think I did something right. No, this is correct. So Michael Burry on top. David Tepper. This thing updates automatically. Guy Spear in the green. Carl Icahn just barely in the red. Warren Buffett beating the S&P. And this is Warren Buffett's portfolio, no, not Berkshire Hathaway stock. I get so many comments where it's like, hey, Warren Buffett, Berkshire's positive. Why are you showing a negative number? If you study the portfolio he reports to the SEC in a 13F filing, that's what I'm looking at. This is what he reported. So I look at the stocks he owns, look at the performance, and that's what's being ranked, as I do with every other investor listed here. So interesting. Well, let's take a look at what Burry owns, man. The Big Short. This is Burry's portfolio. Alibaba getting it done. Baidu. Molina Healthcare. And this guy's more concentrated, right? So Alibaba is really getting it done for him. He's big into China, big into healthcare. This one here, I was influenced by his portfolio and bought into Oscar because I do think they're discounted. And that one is a loser for me. So Michael Burry with healthcare in China, leading all super investors that I cover. I cover 15 of them to this point. The newest one was David Katz. He has Matrix Advisors, and they have a published fund. I'm going to do a video on this guy to kind of showcase what he's about. But here's his fund, a lot of stocks. And he's at 9.22%. You have to pay him 0.75 management fee. So, I mean, this adds up, right? This, if you got a couple $1 million, that's 15 grand a year. 15 grand a year. That's one trip to Europe, or you can lease a really nice car. That's a lot of money. So, I'd rather go ETF on the S&P, or better yet, I'd rather learn how to invest my individual stocks and do better than that and become better at investing and make a lot more money than that. All right, cool. So let's get back on the path of earnings. Chubb. Shadow guy. Here's a ticker, Chubb. They're down. Yeah. So I did look at Chubb closely. And let's take a look at it, because there was some concerning facts on their earnings that I want to cover. So let's get right to shortly after their initial fundamental review, I'm going to get to their investor site and show you the things that were concerning. Okay, so Chubb is been doing okay for the year to date. This year, right? If you're at all in the green, good job. So they're up 2%. Today they're down 2.85%. They pay a small dividend. Market cap's 116 billion, revenue is 55 billion. And overall, I think they're discounted. And I'm going to show you my valuation of them in a bit. Now, let's get to the bad news. And this has a lot of words, so I like schedules more than words. So we're going from net income, okay? And insurance companies are very like the way they write an insurance policy, they have brilliant actuarians, which are super math whizzes. They can calculate with probability, what policies ought to be priced at in order for the insurance company to be profitable and for them to be able to honor every insurance policy they write. So in one way, it's a really complex business where the math is really complex. But putting that off to the side, in another way, it's a very simple business, which is they sell policies. They need to make money on those policies. And they didn't make as much money as they should have in the most recent quarter. So this is for the first quarter, and their net income came down substantially, not a little bit, a lot. Okay, that was a problem. And okay, so that was their return on equity came down because of the drop in net income. So that was a direct attributable item. And then there was other pieces that I read in here. So the growth rate, 3.5, not very exciting. Okay. So that was underwhelming. I found that to be, wait a second, why aren't you growing better? Progressive is growing much better than that. So comparing them to their peer company, that is probably their stock's doing the best. So low growth, less profitability, because I think their cost, and where was that? They showed a nice ratio. Where it showed that basically the insurance coverage cost went up, and that's what shrunk the net profit. So yeah, I was concerned with the earnings, and actually reviewed everything last night, and I wanted to sleep on it, kind of with a fresh mind, kind of look at it again. And that is a concerning report. Now, I think they're going to probably bounce back, but that's maybe a false expectation. I need to wait a quarter and see if it's a trend, or if it's just like, hey, for one quarter they had a bad quarter, and now they're back to the way they were before. One thing did change is their book value went up, meaning their balance sheet got stronger. That's good. But I'm pumping the brakes. Here we go. This is where I wanted to go. So their loss ratio for an insurance company, right? Their loss ratio went up, which is a bad thing. So that's what I wanted to show. They got to improve that. If they don't improve that, their stock is not going to do well. So, um, so I'm holding on Chubb, and I think that the stock could be a very good long-term play, but that earnings report caused me to, I still think it's discounted. If they just operate as they have been operating for a long time, this thing's discounted. And I increased my discount rate because of that quarter, still discounted. So Chubb is going to be a hold for me, but I'm just going to hold for 1 quarter, see how they can change things in 1 quarter, and then come back to it. Chubb is owned by a few super investors. Warren Buffett, of course, and then Tory Funds, Christopher David, Robert Oldstein. So I'm good with Chubb. I think it's a good stock to hold, but I'm not going to buy any more shares for now. So that's my review of Chubb. I wasn't sure how to go about it on a video, to be honest about it. So it's good to cover it on a live stream that we can talk it through, and hopefully when they announce again on 3 months from now, because they just announced yesterday, they right the ship. They kind of figure things out that, hey, you know what? That was a temporary issue. We've got things back on track, and we're going to be more profitable going forward. That's what I'm hoping happens. But if they're more of a trend, then I'll have to really think about this stock, because I think Allstate's doing fine. And let's take a look at Allstate real quick. It's barely higher. So, yeah, I'll have to revisit this in a quarter. So, thanks for asking, Shadow Guy. Sebastian, good to see you. Cool. All right. I think I'm caught up on comments. And if members, if you want me to look at another stock, please let me know. If you're not a member and don't want to be a member, you can buy Super Chat for $5 and then I'll review a stock. So let me know. For now, let me continue on and look at some more earnings. Another company that announced was SAP. And SAP is a big software company. Wow, they're up a big amount, 9.5%. Wow. Year to date, this one's been working, up 12%. 1 year, working nicely. Whew. This is a company out of Germany. This is a big enterprise software company. Market cap, 292 billion. Revenues, 38 billion. They are expensive. If you look at the P/E ratio, 52, that's a luxury stock. It's priced very high. Even analysts are thinking, man, that's an expensive stock. Growth rate looks good, and it looks like they grew even better, 12%. Wow, good job. Very good job. Free cash flow isn't a super exciting, by the way. Look at that cash flow. It's like negative in 24 overall. And it looks like their free cash flow is good in the last quarter. Gross margins are good, 73%. So this isn't the right investment for me, because I think in enterprise software, I'd rather buy CRM. And that's my go-to right now. And there's other software companies that I think have a better valuations and are a better risk reward situation for me. But this one, I mean, might tip my hat to SAP, man. They're getting it done. Look at that. Beautiful. Their earnings are being well accepted. They are the most valuable company in Europe. And they're right up there with ASML. Nicely done. Germany. Germany is getting it done. And I'm actually an investor in this company indirectly because I bought a German ETF and it's basically equal weight like the biggest companies in Germany. So I am, I guess, a part investor in SAP through that ETF. So that is SAP. And I think that the software space offers a lot of really good companies right now. The discounts are really good in software. All right, Shadow Guy. Thank you, man. Good luck. Enjoy the gains. Enjoy the positive day, man. Intuitive Surgical up 5%. This stock, every time I look at it, it looks too expensive. And the stock's really run up, right? It's really run up. It's come back down to earth. It's down a little bit this year. Look at this PE, 74. Man, that's expensive. $181 billion market cap, $8.7 billion of revenue. So investors have to pay, oh man, that's a lot. Let's see, 20, what is it, about 23 times revenue. So their growth is okay, like good, I should say. I mean, that's a good growth rate. But 23 times, that's kind of high. And when we look at their gross margins, this is they're producing a product, right? Like a tangible product with materials and stuff in it. So their margins are not like really, really high. Like SAP was higher. If you just saw their margins were higher. NVIDIA was much higher. These guys are good, but not great. It's just not great. So their free cash flow, that's where I think things fall apart for me, is after everything's said and done, they have not grown free cash flow very much, right? High point was in 2021, 1.75 billion. Well, their valuation's really screaming high, like 880 billion. Well, if I take 1.3 billion and multiply it times 30, and they're growing like roughly 20%. So I'm going to get to like $40 billion of market cap value. I'm nowhere near their valuation. The market, I think, got really excited. This is a surgical equipment company. Is AI going to have robots, doing surgeries? Well, I could tell you this much. I would not like to be one of the first patients where they have a robot do a surgery. I want a nice surgeon that was trained. He's done 100 surgeries like the one that I'm going to need potentially, and go down that road. So Intuitive Surgical, having a good day. They announced, looks like their growth was good. Again, their growth is good. It's just, remember, what I'm trying to do is I don't want to buy this situation where the intrinsic value is below the stock price of a stock that is super popular. I want to find this situation, which is I want to buy well below its intrinsic value, and I want to buy a company I'm excited about, and I want to buy at a discount. That way I could see my investment go up. That's what I'm trying to do. And Intuitive Surgical it's almost like this chart resembles the chart that I was showing that I don't want to do. It's a popular stock. People's minds are, made up that, hey, this is just going to be so, ignore the fundamentals, ignore the quantitative analysis. Intuitive Surgical is just going to be a winner. Well, good luck with that. That's not my investment. That's somebody else's. So Intuitive Surgical, having a good day. But again, today is one of those days where it's like, man, if everything's green, not everything, right? You got some healthcare stocks like J&J and Abbott down. Staples are down a little bit. Oil and gas down a little bit, but they've been having a good time for last couple weeks. But when things are green like this, it kind of is a little bit of, rising tide will lift all boats. Like all these stocks are rising in stock price. So maybe it'll mask a little bit of a problem or a stock that's too expensive. Well, it just rose today because the market's just up. We'll see. We will see. All right. Let's talk a little tobacco. This stock has been getting it done. 40%. I guess all this stress of the market selling off, and are we going to go into recession? How bad are the tariffs going to be? Maybe people that do smoke, maybe smoked a couple extra cigarettes. Maybe. And it created a little more demand for Philip Morris. 263 billion in market cap. Revenue is 38.3 billion. So we're talking 8 times sales. Okay. P ratio is a little expensive at 34. This stock's up nicely, especially over the last year. It's up 80%. Their revenue growth is, I'm a little underwhelmed. I thought the revenue was a little better. I mean, I just showed you an 80% appreciation over the last year. For 7% growth, investors are that excited over 7%. Okay. All right. Free cash flow is outstanding. 10.7 billion in the last full year. Based on their growth rate, maybe go 15 times minus debt. So that would get us to 165 billion in market cap value. Their margins are right there with Intuitive Surgical. And what's their debt level? Let's take a look. So they do have quite a bit of debt, $45 billion in net debt. So the company's actually worth like 120 billion in my mind. So they are priced a little too high. And I think this run up here is the difference. Now, part of the run up is in recessions, people continue to smoke. It's at a certain point, just people smoke. So whether we go in recession or we're in a boom economy, they smoke. That's it. And it's very consistent. So the thought that we're going to go into recession makes Philip Morris more attractive to investors. And I think that's the cause for the run up. That's fine, but I don't buy under those terms. I have to get a discount. So I'm a seller of Philip Morris. And we'll see how things play out. But it looks like their revenue growth was underwhelming. It was not all that exciting. It's just underwhelming. AT&T. Now this company is just up a little bit. It has been doing okay for the year. Look at that, 18.5%. 1 year, 65%. My biggest problem with AT&T and Verizon is their debt level. $136.7 billion of net debt. That's a big number. Hoo-hoo, man. That's a lot of debt. And they have it below 3, which is good. But whenever I value stock like this, I take away that 135 of debt away from the market cap value that I determine for a company. Let's take a look at their free cash flow. Free cash flow is, these guys do produce cash. We're at 19.4 for the trailing 12 months. How well are they growing? Not growing, just stable. Okay, let's multiply that times 10. And we're going to get to, where's that cash flow number? I just lost it. So we would get to $195 billion of value, market cap value, but then I have to decrement the debt, 135. So we're down to $60 billion of value in my book. We're way off. Why would an investor, just think of it in plain terms. You rationalize a company and you go, okay, here are the cash flows I'm going to produce. They're worth 195 billion. Okay, cool. And let me oversimplify it. And I think most people like pizza. So let's talk about a pizza shop. And you're looking to buy that pizza shop business. And the cash flows are such that they produce $195,000 of cash flow value per year when you do a net present value calculation. So you're like, or I should say the net present value of all the cash flows in the future for that pizza shop are worth $195,000. And the current owner says, all right, give me $195,000. You're like, yeah, that's fine. And I'm going to get the business free and clear. Now, if the answer was, yeah, you're going to get the business free and clear, it's yours. Okay, that might be a good decision. But what if, when I asked that question, I'm going to get the business free and clear? They said, no. You're also going to have to pay another $135,000 of debt that the business has. Be like, wait, that screws up the whole net present value, because then I'm not paying 195. I'm paying 195 plus 135, which is going to amount to 330. Well, with that price, it's too expensive. So I'm not going to buy your pizza shop. Thank you. Good luck. Move on. That's the same that I feel about AT&T and Verizon. It's like their debt level's massive. They have to pay it off. Well, when you produce those cash flows, the best case scenario is those cash flows go to investors, dividends, buybacks, load up the balance sheet with cash, have a special dividend every once in a while, give back the cash to the investors. But in AT&T's book, no, we're going to generate cash and then we're going to pay off that debt. Well, there's no value to the investor. So that's my problem with AT&T. It's too much debt. I am out. I am a seller of AT&T. All right. So, all right, let me take a quick break. And since we've got a lot of people, let me invite you to become a member of the channel. You can get to the membership page, just click on join, and you get signed up. Then you can ask for tickers to be reviewed on the live streams. You can attend member calls. You also get access to a directory of the tools that I use, as well as a listing of all the valuations that I perform. I update it once a month. And you can basically go to that sheet and say, hey, let's look at, let's go back to NVIDIA. You can go see my work on NVIDIA. And this is just more of a reference point. I don't recommend you buy, hold, or sell any stock, but you can look at the work that I've performed and always have it 24/7 available to you. So consider being a member. It'd be great to have you. Or on these live streams, if you want me to review a stock, a $5 super chat, and you buy one of those, and I will review the stock that you're interested in. So let me know if that's something you'd like to do. Okay, so got a couple more symbols where the earnings were announced. So let's take a look at those. And before I do that, let me take a quick peek at the market, see what's going on. So the US market, the NASDAQ, wow, we're up 4% now. Beautiful. S&P is up 3%. Jeez. That is good stuff. Excellent. And when we look at the heat map, all right, looks like Amazon just tearing it up. Meta having a good day. NVIDIA, Broadcom, AMD having a real good day. Intel having a good day. Wow. So technology is just crushing it today. Looks good. All right. So the next stock we will look at is GEV. So GE Verona Energy Company. So they do equipment for electricity production, storage, and the expectation is they are going to sell a lot of product to customers that are going to generate power. And it looks like Vertev is a related company. I'd like to look at that one because I've been a big bear on Vertev, and it sounds like they're up 20%. Wow, that looks pretty cool. So this company market cap is 94 billion, revenue 35 billion. So not too bad. You're paying about 3 times revenue. The PE is really high, 49.8. They better be growing a lot. Stock is really flourishing. Most of the gains are over the last year. Now, when I look at this number, this is where the disappointing theme song comes out. Wah, wah, wah. 6%. Why is your stock up 150% and your revenue's up 6%? My spidey senses say you're incredibly overpriced, but maybe my spidey senses are incorrect. So let's keep going. $3.3 billion of free cash flow. Okay. 6% growth rate. That's not very good. Multiply that times 15. I get to like maybe 54 billion dollars. These guys are priced at 94. So I will pass. I'll let somebody else invest their hard-earned money into this stock, because if this stock's just going to grow at 6%, no, thank you. Last quarter they did grow at 10.6, but the point's still made, which is this is not exciting growth. Why would I buy a stock where it's up 150% for that type of growth rate? No thanks. I'll pass. Now, a company that I've been really a bear on is Vertev, and it's not up 20% like that. It's up 11.45. Did they announce today? They did. They announced today. They're a $30 billion market cap company. They did grow nicely. They're growing 24%. Now, my big hang up on Vertev is similar to the analogy I used with the high performance data center company. I think it was Nebius, and NVIDIA, right? They're in the same ecosystem. So is this one here. But when we look at cash flow, $1.3 billion of cash. We look at gross margins, 36%. This is really low margin business. These guys are doing the plumbing, a lot of equipment, cabinets, racks in the data center. These are low margin products. So for these guys to be caught up in the whole AI data center build out craze, I think is risky for me to be an investor. So I don't invest. And I actually shorted these guys, and that was a successful short. When we look at this company, I think their stock price has been places. It went up and it came back down. It came back down hard. I think this year it's down 29%. And this one here, I mean, could I get to, this valuation? I probably could. I'd probably multiply that 1.3 times 15 and get to $20 billion of value. How much debt did these guys have? They have a little bit of debt, not too much debt. I just think they're overpriced, and they're very vulnerable because they're a low margin player in a business that, you have these giants that are already crumbling down. If you look at the NVIDIA stock, right? NVIDIA is not doing well, and they have great margins, cash flow, growth. I mean, these guys are growing like crazy, right? And if their stock is going to crumble, Vertev has no chance. No chance. I'd rather buy NVIDIA than Vertev if I'm going to take a chance at the data center right now and buy into the data center build out. So that's my position on Vertiv. I think Vertiv continues to be overpriced and really risky. I think if we get and we're beginning to see signs of the data center slowdown. I think Amazon did announce that they're going to pause on some of the data center leases that they have. They quickly kind of said, "Hey, well, that's kind of normal. We do that from time to time." But the fact is that, well, if you have this data center build out where we can't get data centers fast enough, why would they be pausing on leases? You would think, no, you'd build that one out too if you have that type of demand. So to me, that's a tell that, hey, demand maybe isn't at as extremely high as people have been saying. The other kind of uh, tell or evidence that the data center maybe isn't building out as fast is NVIDIA had a $5 billion of chips that they had that were going to go to China. And the US government said, no, you can't send them to China. And they wrote off the inventory, which in my book is like, wait, why would you write off inventory? Why don't you sell it to somebody else? I thought the demand for your product was extreme. Well, maybe the demand isn't extreme. And they wrote off that inventory, which was a big surprise. All right. So that's Vertiv and GEV. All right. So Mike. So my bigger fan of SoFi or NU. My choice is NU. And let's take a look at all three. So NU, so SoFi, NU, and Hood. So for the 1 year, Robinhood wins that race. SoFi, second place. New Holdings, third place. Year to date, looks like Robinhood wins that race. NU, second place. SoFi is negative for the year. Just when I look at the businesses, to me, SoFi is the least valuable. The reason I like Robinhood is they are really profitable. They also have cut a part of their market and said, we're going to do things different and we're going to disrupt. And they have successfully done that. And now they're getting into gambling. They call it something else. They try to make it sound like it's not gambling, but whatever. It's gambling. And they're going to have a new product, which again, they break rules and they're like, no, we're going to recreate something that the consumer wants. We're going to create it in a way that we think we ought to run it. And that's what they're doing. I love that. I think that's great. That's an innovator. That's a disruptor. I love NU's access to the Latin American economy. The Latin American economy, Brazil, Mexico, Argentina are on the up and up. And I like that access to those markets. So that's why I invest there. Just SoFi, there's risk to it. I don't think they're incredibly profitable. And I don't think they have as good as fundamentals as these other two. The best one being Robinhood. So having choices, Robinhood continues to be my number one choice, although their stock's really up. So Robinhood really peaked at the end of the year, came back down, but overall it's done well over the 1 year. It's up 163%. SoFi is up 59%. That looks good. And then New Holdings isn't up very much. It's kind of a stock that's recently gone up. And, the one thing that this tariff war has, created, or maybe it was going to happen anyway, was that, the US market certainly was getting a big portion of investment from international investors outside the US. And now I think investments are, in other countries like China, Latin America, Europe are becoming more attractive because the valuations are better. And New Holdings kind of gives me that, hey, I get to invest outside the US, which isn't, I mean, most of my stocks are US based, but it's good to have a couple of stocks that are outside the US just from a diversification perspective and a hedge on US. Like if US sticks to the tariff war and creates a really bad environment for the US and globally, man, it's going to be tough. So it'd be good to be invested a little bit outside the US. So that's kind of where I've been for, I would say, about 6 months. I continue to look at SoFi and just was never convinced that that was the best choice for me. Their growth is good. They are profitable now. That looks good. And these guys act more like a bank. So I mean, look at their book value. So their book value has gone up, but it hasn't gone up great. It's just gone up a little bit. I think when you look at new, I think that is one of the differences. When you look at banks, in my opinion, you need to look at book value. That's a measure of the bank's true value. You look at new, right? Look at this growth rate. That is true growth. Boom. Just going up nicely. The kind of gold standard within banking is JP Morgan. I was an investor for a long time. And their book value is textbook what you're supposed to do as a bank. Book value. Look at this book value. 70 up to 120. Textbook. The only problem with JP Morgan is you need to pay the price for the best run bank out there. And to me, the price is too high. I was an investor. I made money. I got out. There's nothing wrong with making money on stocks and then, taking the gain. And just felt that I could switch horses, and I switched over to Citibank and feel like that Citibank investment's going to pay off better going forward. But when you look at SoFi, they don't resemble JP Morgan in the book value. It's been kind of sticking to this 5 for a while. Okay. Like it didn't move a whole lot from 2022 to now. Hasn't moved a whole lot. So those attributes, I think, are what keep me from being a SoFi investor and being overly excited about them. But I think that the other aspect to some of these stocks, right, that the retail community and frankly, just about anybody can understand the SoFi business. And they understand that, hey, their products make a lot of sense. And the easier it is to understand for the general public, the more risk there is that a stock is bid up just because people understand it. People understand Netflix. Oh, everybody has streaming service. Everybody's going to want streaming service. So I'm going to be an investor. It's a good business. Well, maybe it is. But the businesses that are hard to understand, that make a lot of money, that maybe are inefficiently priced, meaning they're priced at a big discount, that's where I can make money. It's seldom that I can find a business like Disney as an example. I've always thought Disney was too expensive. When I was in my 20s, I invested in Disney, and it ended up where I lost money. I've since become aware that Disney has a lot of costs. They don't generate a whole lot of cash, and I've stayed away from Disney. But a lot of general investors are like, Disney's a good business. When I went to Disneyland, I had to pay like $200, $300 for a ticket to get in. I go to the movies, I see a Disney movie, it's great. But when you look at their costs, you're like, geez, too expensive. So SoFi, I think, is in the category of it's easy to understand for the average person, the general public, and it becomes a stock that gets invested by new investors, people that are like, hey, I understand the SoFi business. I understand their growth. They're everywhere. I'm getting, advertisements online by SoFi. I'm going to buy it. Okay. Well, I understand that. I understand the rationale. It's just not the type of investing that I want to do. I want the best discount possible. I want the best business possible that I'm going to put my capital in. When I compare those businesses, the best business possible is Robinhood. And then I invest in you for other reasons. And SoFi is left off to the side because I made my decisions. All right. So that is SoFi. All right. We covered a lot of ground. We covered a lot of stocks. And I agree with your comment, Mike. We are on the same page. I do think that SoFi is the bank of the future. I like what they're doing. I think their products are good. I do agree with that. All right. So let's take a look at the market and then I'll wrap things up. Market's picking up steam. Amazon's up 8%. Oh man. Go Amazon. And Meta's up 6.2%. Tesla's up. Ooh. What's interesting is there is some stocks that are not going up, like a couple in consumer staples. Energy is down. Chubb is down. We covered Chubb earlier. And then J&J is down. So that's a big cap stock. Man, it's going to be a fun day. It's going to be a fun day in the neighborhood. All right. So I will wrap things up. You guys that are not members, it'd be great to have you as a member, and you can get fairly easy. Just click that join button. You're good to go. You can go through the instructions there. It'd be great to have you a member, and you can attend member calls. We're going to have one tonight at 8 p.m. Eastern. We've got some stocks to review, and you can join one of three or all three calls per week. We have one on Tuesday mornings, one on Wednesday nights, one on Sundays in the middle of the day. So get signed up. It'd be great to have some of you that have been on the streams for a while. It'd be great to hear your voice and talk about stocks, man. Figure out how we can make some money in this market that I think may be becoming, we may be pivoting, right? We have gotten kind of like through a really rough patch where stocks really sold off on the fear that we had in the market. And maybe we're going to see that pivot point and we're going to start to rock and roll upward and onward from here. It'd be a pretty sight. But if you become a member, we get to talk through the rough times and take advantage of the good times. So please consider it. It'd be great to have you. And that is it, everybody. Enjoy the day. It'll be easy to enjoy today, man. Are you kidding me? Oh, man, look at this. Nice day. Yeah. Beautiful day. And I'm going to go hit the gym with a little extra energy because I know that I'm making money, a lot of money today. And I'm glad. I forgot to cover one important aspect. I should have covered this super early. Is I know that, it's probably been said 100 times just in the last month, is you got to stay invested. This is exactly why you have to stay invested. Is the people that think they're geniuses and completely go to cash, then they come back in. Man, it's really hard. It is so hard to predict. For 2 days, we're going to go up nicely by 7%. So if you had gone all cash, you missed 7% move on a couple $1 million. That's $140,000. So you left $140,000 on the table. On $1 million, it's $70,000. $70,000 incinerated because you were in cash, completely in cash. So those whole oh man, people get out of the market because it gets ugly, it gets rough. Don't be one of those. Be more of an intelligent, long-term minded, fundamental based investors that is dealing with the adversity and trying to take advantage of the adversity, trying to take advantage of the risk. It's an opportunity disguised as a big, scary monster. So I would leave you with that, hey, we got to stay invested. We got to keep thinking, analyzing, finding the right businesses, and taking advantage of these corrections so we can make lots of money long term. And that's it, folks. Have a great day. Talk to you soon.